Good afternoon, class. I want us to welcome you again for our discussion this afternoon on the topic that we started looking at last week. And just to, as a matter of recap, let me mention that there are 5 different types of accounts. There are 5 different types of accounts, and we've just talked about them. There's the first one, the income account. 2, we have what is known as expenditure account. And then 3, we have the asset account. And then 4, we have our liability accounts. And lastly, we have number 5, our capital accounts. And of course, we shared this last week when you're doing our equation, the accounting equation that comes from the last 3 types of accounts, where we said assets equals to capital plus liabilities. And we further subclassified assets as current assets and non-current assets. And again, we classified liabilities as current liabilities and non-current liabilities. So just to have it in your memory, again, that we have those types of accounts and how they give us the accounting equation for your recap. Accounts are also further classified as either impersonal or personal, and other impersonal we have nominal and good account. And I think in our notes that we shared, you can be able to again go through them so that you can be able to be acclimatized with some of them. But today I wanted us to have a question which I want us to review. I'll probably go through it and review it at the end of the day. And the question is, let me read it so that you can be able to get it. And of course, as I look through our question, remember our rules and regulations where we were talking about debit entries and credit entries. And we say that assets which equals to liabilities as part of capital plus liabilities. Assets, when they increase, we debit them. When they decrease, we do the opposite. Capitals and liabilities, when they increase, we credit those accounts. And when they decrease, we do the opposite. I was talking about accounting being more or less like a salsa dance, where you move on the opposite sides of directions. So on assets, we have our current assets and non-current assets. On our liabilities, we have our current liabilities and non-current liabilities. We've talked about incomes and expenditures. When incomes when expenses increase, we debit those accounts. And of course, when incomes increase, we credit those accounts, and the opposite is true. And we talked about our rules that are there. I think you have all of them as we populate that particular rule book in terms of trying to understand a number of issues. So today, let us look at this particular problem. Mr. JK started a business in 1st of January 2010. And I mentioned the other day that accountants they have this acumen of attention to detail. I think we talked of it as one of our rules. You have to be on attention to details on the debit side. Equally again, on the credit side, there has to be an attention to detail. Of course, we're doing that because of the double entry concept that we've learned in class also. So we are doing whatever we are doing on the credit side has an opposite reaction on the credit side. Every transaction has a debit and a credit entry at the end of the day. So Mr. JK started a business on 1st of January 2010 and with a capital of 1 million shillings. So he has that capital of 1 million shillings, which he paid into the business bank account. So this 1 million shillings is in the business bank account. So this is in the business bank account. Then again, we are told that on the 6th of January, he purchased a motor vehicle and paid by check 400,000 shillings. So on the 6th of January 2010, he purchased a motor vehicle worth 400,000 shillings and paid by check. So he paid that by check. Then on the 9th of January, he purchased goods for resale on credit from ABC Company Limited worth 200,000 shillings. So on the 9th of January 2010, he made purchases for resale of goods from ABC Company Limited on credit, and they were worth 200,000 shillings. They were worth 200,000 shillings. Then on the 13th of January, he sold some part of these goods to XYZ Company Limited on credit, again for 150,000 shillings. So that is again on the 13th of January 2010. Now he made credit sales to XYZ, and they were amounting to around 150,000 shillings. 150,000 shillings. Then he paid ABC Company on the same date. Not on the same date. He paid ABC Company the amount outstanding by check on the 25th of January. So on the 25th of January, he made a payment on the 25th of January, a payment of the goods that he owed and had picked from ABC Company Limited. ABC Company Limited. Of course, we are required now to open up those ledger accounts, pass the the entries into the ledgers, and of course balance them. So on the 25th of January 2010, he made a check payment to ABC Company Limited of the amount owed. The amount that is being owed. So that is what we want to try and look at, and try see how to open up those ledger accounts, then balance the books. And of course, as we were talking in our previous class, one of the ways of trying to confirm that our books have been balanced is the aspect of drawing a trial balance, which is a summary of all the accounts that we have opened. So let's start with the first transaction, which is on the 1st of January, where I introduced capital of 1 million and it was banked in the business account. So that particular transaction affects what is known as the capital account, because that is what has been introduced in the business, and then again the bank account, because that money has been sent into the bank. That money has been sent to the bank. Capital account being a liability account, when they're increasing, we credit them. Bank account being a non-current asset account, being an asset, we debit it when they increase. So on our debit side of the bank account, we have capital. This pen is not behaving so well. We have capital of 1 million. On the capital account, to satisfy the double entry concept, our capital is increasing. This is debited. So we again credit this, we debit this, we credit the bank capital account of 1 million shillings, and this is right in the bank. So that clears and satisfies that double entry concept. Then the second thing we are told, on the 6th of January 2010, he made a purchase of motor vehicle, and by check, worth 400,000 shillings. So if the moment you hear the word check, that means it is coming from the bank. So we look at the bank. Our bank is now decreasing because we are making purchases, but he bought a motor vehicle. So our bank is decreasing. This is an asset account. If it is decreasing, we credit it. So we come to the credit side and we decrease it by 0.4. Let me now write the figures well here. So let me just do 1 million there. This also will be 1 million. So you bought a motor vehicle worth 400,000 shillings. So this goes to the motor vehicle account. So our next account that will be opening up here is a motor vehicle account. And of course, this is a credit entry. The corresponding entry here will be a debit entry of 400,000 shillings, and this is from the bank. So again, that satisfies the double entry for that second transaction. So we move into our subsequent transaction, and that is the transaction which was done on the 9th, where he purchased for resale goods from ABC on credit worth 200,000 shillings. So that means we are having two accounts again. We have the purchase account and then we have the ABC account. So we have our, let me just do it here. We have our purchases account there. And then let me just remove our rule book, but ensure that you sustain it. So we have our, so that is our purchases account, and this is ABC account. So we have made purchases, and we have made purchases worth 200,000 shillings, and then we now debit it here, and we are debiting ABC 200,000. That is ABC. ABC becomes our creditor, a liability, a current liability. So we have purchases there worth 200,000 shillings. So that again satisfies our second transaction. We move into the next transaction where we're talking about a credit sale to XYZ amounting to 150,000 shillings. Again, that is another account that we are opening. We have sales account, and then we have the XYZ account. So our XYZ, because we are selling to them on credit, becomes our debtors. We owe them. They owe us money. They will have to pay for us at the end of the day. Though that is another current assets, or what we would call their accounts receivable. The ABC is accounts payable. It's an account that we need to pay. The XYZ is an account that we need to receive at the end of the day. So what happened on that day? There were credit sales amounting to 150,000 shillings. So XYZ, we have 150,000 shillings there. Then we have sales here of 150,000 shillings. So that clears the double entry concept. Then we move into the last transaction where they paid by a check the amount owed to ABC. So when you come to the ABC account, they had a 200,000 shillings there. That's what they owed. Then they paid them. So when we are paying, our bank account decreases. As it decreases, we credit it, and this is going to ABC, and the amount that we owed them is 200,000. So we come over here and we say bank has cleared that 200,000 shillings. So that has cleared all our transactions that are required to be passed. The next step now is to balance off the accounts, And I mentioned the other day here, one of our rules is that we have to be neat in the way we are doing it. I wish I had a ruled board where we now see how we balance them off. And because we know, we start with this one, the first one here, because we know this is a capital account, the credit side should actually be more than the debit side. In fact, on the debit side is when now the owner of the business withdraws capital from the business that he had introduced. So I will always do a line here to close. Of course, then I add this total here. That's a million. I expect this to again add by a million. And because here is 0, now I introduce that a million, and that becomes my balance carried down. Then I bring it over here as a balance brought forward, and the figure there is 1 million. So you will see that I've closed the figure here, but I've moved it again to form my balance brought forward. So I'll do again the same thing to motor vehicle. I'll have the figure there, 400,000. So this is the additions row. That is 400,000, simply because this is 0, so this becomes 400,000. Try to can get another pen. So this is my balance carried down. Of course, I'm bringing it over here as a balance brought forward. Oh, this is even way better than that one. Well, should get another pen. So that is 400,000 there. So I come to bank. Of course, this is a million. This is 600,000. So this is greater than the other side. So I'll leave a space here for the balancing figure. So I'll come over here, same line in the same row. So this is a million. This should also be a million. But because this is 4 plus 2, that is 6, the balancing figure there should be 400,000. So that is my balance carried down. My balance brought forward will be 400,000 shillings. So I'm just moving the figure down there. Then I get to purchases, I do the same thing. Balance it there. That is at 200,000. 200,000. My balance carried down is 200,000. Then my balance brought forward is another 200,000. The ABC company, because the debit side and the credit side balance is off, so I just do a double line to ensure that it is balanced. The sales account again, I'll do that. This is 150. Again, this is 150. My balance brought down or carried down is 150. Then my balance brought forward is 150. Then I come to XYZ company again. This is 150,000. 150,000. Balance carried down is 150,000. Because Mwalimu spend getting finished. Then balance brought forward is 150,000 shillings. So we have balanced off all the accounts. The capital account has balanced to 1 million. The motor vehicle balanced to 400,000. The bank account balanced to 400,000. The purchase account again balanced to 200,000. The ABC account has balanced to 0 because it has cleared. The sales account has a balance of 150. XYZ also still has a balance of 150. Then the next thing that you do after that is to draw what is known as a trial balance. A trial balance. And the trial balance, we say it is now a summary of all the accounts. A summary of all the accounts. It is what now tells you whether you have posted your accounts well. So let me probably start over here. If I was to do a trial balance, which has it's in 3 sections: the debit side, and then of course the credit side. Then we have the details, which is purely the account. So our first account, there is capital, and the balance is 1 million on the credit side. So we have 1 million. Our next one, so I can delete this one, done with it. Our next one is the motor vehicle. Motor vehicle, the balance is on the debit side, 400,000. I can also delete this to give me space. Our next account now is the bank and the purchases. So we have bank and purchases. Bank is 400,000. Purchases is 200,000. So I can also delete them from here. So our next one, ABC, we cleared. We have now balance there. The next balance there is the balance for sales. So sales, the figure there is 150 on the credit side. Then the last one is the one for XYZ Limited, and the balance there is 150 on the debit side. So we have taken all the balances in our ledgers to our trial balance. Our next step is to just ensure if our trial balance is balancing. So when you add all this will be 1,150,000, and this will be 400, 400, that is 800 plus 200, that is 1 million plus 150, that will be 1,150,000 shillings. So that gets us through into how we move transactions from the ledger accounts, balancing them off, taking them to the trial balance, and then balancing the trial balance to just check and to ensure that we have done errors. Of course, it has balanced, so our first thing is to give ourselves a thumbs up for working on it, and it is balancing. Of course, as we progress in accounting, we will also realize that the fact that your trial balance has balanced does not mean that you're free of errors. It just means you have the first step, you've cleared things, done them a little bit rightly. But if there are errors that cannot be exposed by the trial balance, they would still be there, but we will get there on how to be able to identify them and how to be able to close them off when the errors are again realized. Of course, that marks the end of our discussion again on this. When we come back again, we will be now looking into how do we now start preparing the final accounts. The final accounts that has the statement of comprehensive income, the statement of financial position, and others that will be coming along as we continue with our class. Till then, I want to wish you all the very best and see you in our next class. Thank you.